think, act, and prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show where we think, act, and prosper. Now, it's been a while. It's been over a year, but I want to welcome back Mark Yusko to the channel. How you doing, man? A lot has happened in the last year.
Oh my gosh, what a year, and great to be back. I always love talking to anybody from the old hometown. I grew up around the Seattle area, and in fact, I've been back twice over the summer, literally day trips, crazy, day trips from North Carolina, but a couple of good crypto events in downtown and enjoyed those. And the mountain was out in full force for me, so that was great. But
Yes.
great to be with you this morning.
Yeah, I actually I work in Port Townsend, so I did I was driving, and sometimes you get these sunrises, and you see the mountains and the water and everything. It's just so beautiful.
Unbelievable. I mean, Port Townsend, one of my favorite places. We used to do a loop up through San Juans, et cetera, with the boat. I spent probably 30 weekends a year growing up on the boat, hanging out in Kingston and cruising all over the Puget Sound. And I miss those days. Boating on the East Coast is just not really, not the same.
Yeah. Is were your family, were they tied to the maritime industry at all, or?
No, my dad grew up, actually, speaking of East Coast boating, grew up in Connecticut. He and his dad, one of their things is they built a boat, a little fishing boat, and they used to go out in the water all the time. So he just always wanted to be around boats, and we kept one in Bellevue and would take it out through the locks and go to Kingston every Friday and hang out for the weekend. And I said I miss those days. Life was a little simpler way back when.
Yeah, for sure. So yeah, we got a lot to get into today. So it's been a year. We have a lot of events happen. I mean, you made a really good call last year. I remember I would go back and listen to our interview, and at that time Bitcoin was down quite a bit. I think it went back down to 29,000 at that point. It was last summer, and so I was just buying in heavy. I did sell when I made a profit, and I'm glad I did. I did.
Look, we're in a really interesting period, and that summertime conversation. We were down, close to 50% from, maybe right around 50% from the peak in February, and that February peak was really induced by leverage, right? There was a lot of leverage in the system. Now there's a lot of leverage everywhere. There's a lot of leverage in real estate. There's a lot of leverage in the stock market. In fact, still way too much leverage in the stock market. But there was a lot of leverage in crypto. And, I shouldn't rat out a family member. Actually, I won't rat out a family member, but I have a family member who called me up around this time. Is like, they stole my Bitcoin. I'm like, what are you talking about? It's like, well, I was at Bitfinex. I go, stop. Okay. So you levered up your Bitcoin, right? To crazy amounts. The price goes down. Either make the margin call or you don't. If you don't, they seize the collateral. That's not stealing. Now, if the business model of the firm is to entice people to lever up to get speculative returns, then maybe we could argue whether it's stealing or not. But the bottom line is there was too much leverage. And I remember the conversation was, it's likely that we had seen kind of an intermediate bottom and that we'd have another kind of recovery because we didn't get all the leverage out of the system. And one of the worst things in investing is, if it's a 2x2 matrix, good decision, good outcome, good decision, bad outcome, bad decision, good outcome, and bad decision, bad outcome, right? Bad decisions, bad outcomes, they're great. They teach you, don't do that again. the worst thing that can happen is a bad decision with a good outcome. So you make a bad decision, you buy something silly, you buy something on leverage, you gamble on something, and it works out. And it makes you think you're smart. And then you do it again. Then you get the bad decision, bad outcome. And so I do think that peak we saw in November, where everybody was, laser eyes till 100K and we're going to the moon. And you had people, I love a lot of the gang out there that are, banging the gong.
I took my laser eyes off. I took my laser eyes off.
Yeah. I never put them on. That's not true. I did the whatever you do, the Photoshop to put them on, and I posted it and I looked at it and no, it's stupid. And I don't mean stupid like I just thought I looked stupid. So I didn't like it. So I didn't do it. Not for me. But I think the concept is fine. Getting a group together and identifying, it's like looks like wearing a polo shirt, right? I mean, you wear things that identify you to a group. Usually more like country club, or a Seahawk logo. Like I love I'm very distressed. My Seahawk hat disappeared.
Oh wow, yeah.
So my wife did just order me a new one, but yeah, I don't know what to do if I don't have my Seahawk hat on. So what happened was you had this rebound rally, and people were over ebullient, and that leverage came back in. And I think what people missed was, I talk about this lately, that there's the Gandhi quote that I guess Gandhi actually didn't say, that everybody thinks Gandhi said, but some other guy who I should remember who that was, but that, first they ignore you, then they laugh at you, then they fight you, then you win. And 2009 to 15 was the first they ignored you phase, right? Bunch of nerds and geeks talking about crypto. Who cares? Just go away. It's whatever, magic internet money. Then they laugh at you. So 2016 to 21, it's like, ha, 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 bunch of nerds and geeks playing with their magic internet money. Who cares? But now then they fight you. And starting November of last year, the financial services industry declared war on crypto, and particularly Bitcoin. Because what they did is, by not approving the spot ETF and approving a futures ETF, what it did is suddenly everyone's demanding futures. Well, if somebody is long futures, someone else is short futures. So it allowed the big institutions, the big banks, the BlackRocks, et cetera, to go short futures. And when you can short paper out of thin air, that puts really bad pressure on any asset. So you've seen this in gold, you've seen it in oil, you've seen it in gas, you've seen it in anything where you can create paper goods. Like in the old days, if I wanted to trade oil with you, Daryl, I actually had to have a barrel of oil. You had to give me money. I actually had to deliver a physical barrel of oil. Well, in the futures market, I can just sell you a magical paper barrel of oil. And as long as we set up the contract before I'm supposed to deliver, then I don't actually have to physically go get oil. But those markets get out of whack and they get out of balance, and they tend to cause peaks and troughs. And so, the most recent decline from 69,000 all the way down to 17.5 was the result of the unwinding of that excess leverage and the relentless downward pressure from the futures market.
Yeah, so a couple thoughts on that. One thing I was thinking about is how the bad decisions, good outcomes. I feel like a lot of people experience that. Like I'm still getting people talking about like, hey, buy these tech stocks, and I don't feel like it's over yet. We had a bear market rally, the Fed's coming out tightening or whatnot. And I'm like, yeah, a lot of risk assets are still in that danger zone.
Oh, Daryl, it's unbelievable. I mean, let's just pick on a couple. So, I'll pull one up here, Shopify. Okay. Perfectly fine company. All right. This thing ran from $11, right, at the beginning in 2019, all the way to $176. Now, here's the problem: it's not the price. The price is one thing. The problem is this is a company that got to a market cap. So let's see, they did 2019. Let's do 20. So 2020, they did $3 billion in revenue. Made a tiny fraction of money, but they did $3 billion of revenue. But their market cap at the peak was about 300 billion, right? So you're talking about 100 times revenues. There's no company on the planet, not one, that should actually sell above 10 times revenues. I mean, why am I blanking on his name? But not Steve Jobs, but the head of Sun Microsystems, it'll come to me. But in 2000, during the first tech bubble, he said, look, my stock's now trading at 10 times revenues. The problem with that is for you to earn a 15% return, I would basically have to give you all of the revenue for the next 10 years, which is kind of problematic because I would go to jail because I have to pay taxes, I have to pay my employees, I have to reinvest in equipment. And so that's impossible. And then Sun Microsystems went down 98%. And 4% in the craziness of 2000, 4% of companies sold above 10 times revenues. In the most recent tech bubble, tech bubble 2.0, 15%, almost 4 times more companies sold above 10 times revenues. And there were some like Zoom, like Shopify, and a handful of others that were 100 times or more. And so buying those companies at those levels was foolish. Buying them at 10 times is foolish. 20 times is more foolish. At 100 times, it's just flat stupid. But the problem is if you bought it at 50 times and it doubled and went to 100 times, you're feeling, oh, I'm smart. I'm a good investor. No, you're a degenerate gambler that got lucky. And I still think, to your point, we're still far, far away. Not for every stock. And Shopify's down, how much is it down last year? A lot, but let's figure out exactly how much. 1 year. So it's down 80% in the last year. The problem is it still trades at 10 times sales. So I could make an argument that it could go down 75% from here to get to fair value. Now, I'm not saying it will, but I'm saying it could. And there are other companies like Zoom, right? Great product. We're using it right now. It's a good product. But it was trading at 120 times revenues. It's down 90 some odd percent. Peloton, again, was trading at silly levels because, the funny thing about Peloton, it's kind of how I feel about Tesla. Tesla's a car where you bolt it on an iPad. It's a fine car. It's good. Okay. But it's a car, right? It's not a piece of software. It's a car. And most of the time it sits empty. Most of our cars sit empty 95% of the time. We're in them about 5% of the time. So it's a car. Peloton is an exercise bike with an iPad attached to it. Everybody says, I'm going to exercise. So they buy the exercise bike and then it becomes a clothing rack. And then it gets sold to play it against sports. And so there are very few people who have the discipline to work out all the time. There are very few people who have the discipline to use a piece of equipment in their home because they just aren't that disciplined. So it's tough. And so that business was likely to go down. Now, maybe those stocks have fallen far enough that they could recover, but there's still a whole bunch in the Fang Man space that I think are still egregiously overvalued. But we are where we are.
Yeah, for sure. And that kind of brings us to just kind of to the next thing I was thinking about was just with liquidity. And so a lot of these risk assets will run very strong when there's heavy liquidity. We saw, the M2 money supply increase dramatically. And I'm kind of just wondering, how does that look like going forward if the Fed is, tightening and, I'm not sure when they'll start QE again or whatnot. I don't know if they need to break something first or what.
It's really interesting. And we have analog for this. And it's such a great insight, Daryl. If you think about all the things that really impact investors, liquidity is the number one, right? It's the most important thing to understand. Because at the end of the day, central bank liquidity has become the only way to get nominal growth. And this is the illusion that's happening. It's called money illusion. And like I said, I grew up in Kirkland, Washington. I used to go to the Totem Lake, 7-Eleven with my dad to fill up the car. And I remember, like vividly in my brain, I remember paying 31 cents a gallon for gas. Now, I put gas in my car the other day and I paid $5.31. That gallon of gas does the same thing. It produces the same amount of heat in the engine. It's actually a little less because it got ethanol in it, but let's assume it's the same gas. It didn't get better, it didn't get more efficient, it didn't grow, same gas. But why am I paying $5? It's not that the gas got better, it's that the money got worse. And I would buy a gigantic, not it was good for me, but I'd buy a gigantic Slurpee, for 29 cents. Now a Slurpee is like, $2.29. And still probably shouldn't drink them very often, but they do taste good. The only thing I miss is in the old days, those Slurpees would come in a collectible cup. I had a Roberto Clemente cup. I had Reggie Jackson. And then my mom threw them all away, which just kills me. But I had some of the best Slurpee collector's cups. But the reality is that the money's getting worse. And so if you think about since 1996, that's a long time, right? Since 1996, everybody's like, stocks are up so much. Right? Well, they're only up because you denominate them in toilet paper, in the US dollar. If you denominate them in money, right? There's only one money in the world. That's gold. Gold is money. Everything else is just credit. Everything else is just debt. It's backed by debt, insured by debt, backed by central banks. Gold is an asset that exists in the absence of a liability. It's the only money that there actually is. And that's why for 5,000 years, it's been a perfect store of value. But since 1996, the S&P 500 priced in gold, dead flat, no increase. And so we're tricked, we're fooled into this idea that inflation is somehow good for us and that stealing our purchasing power by making our money less valuable is good for us. As long as the things that we own, as long as you are one of the few people that own stuff. Remember, 49% of people in this country own zero stocks. They don't have a 401k. They don't own stocks. They don't have a Robinhood account. That's half the country. Now, the people who do own them, they love this, right? They love that stocks are going up, making all-time highs, but it's in nominal terms, or they love that their real estate's higher. I go back by my house in Kingsgate, and I think the last time I went there, it was priced at $1.4 million. Now, this is not a mansion on Lake Washington. This is a little tiny cracker box house in, Kingsgate, which was a nice little neighborhood, but the yard is about this big. And we had, 3 bedrooms, split level house. It was fine. It ain't worth $1.4 million. But it's not that. It's that the money got worse. And that's where we are today, is we're living in this world where the central bankers create liquidity to fuel this illusion. But to your point, over the past year, since we last talked, right, up for the 12 months before we talked last summer, the Fed had doubled the money supply. Just let that sink in for a second. So we've been a republic for 248 years. 248 years. And in 18 months, the Fed created half of all the dollars in the history of the Republic. So it was logical that everything went up. Real estate prices went up, stocks went up, because they were going up in nominal, inflated away value. And so now, in the past 12 months, for the first time in 45 years, money supply contracted. Now, it only contracted 3%, but it actually did contract. And it's not then shocking that equities are down and that real estate prices are starting to fall. Maybe not in Seattle, but in places where I live, you're starting to see it fall. Actually, that's not true. North Carolina is still going up because Apple's coming here for their second office. So a lot of people are moving here. But New York, California, other places, prices are starting to fall. And so we have this interesting dilemma where what's going to happen? Now we have an analog. We can look at Japan. In 2008, the Bank of Japan said, no more QQE. They call it QQE, quantitative and qualitative easing. And they said, we're not going to buy any more bonds. We're full up. They were at 80% of GDP on the Bank of Japan's balance sheet. Now, if you go back and look, they stopped for a couple months and they've gone straight up ever since. They're at 135% of GDP on the Bank of Japan balance sheet. We're like at 45% here in the US. And why did they keep going? Because they have no choice. The only way out for Japan, because they don't grow demographically, it's a nightmare, right? They have a monster number of 65 to 85-year-olds. They're 11 years ahead of us demographically. And the biggest problem for the United States is a declining workforce, right? Every single day, 10,000 people turn 65 every single day for the next 17 years. And those people, they don't work as much. They aren't as productive the way we measure productivity. They're perfectly nice people. I'll be one, in 6 years. But the reality is working age population growth is entirely correlated to inflation and interest rates, both of which are inexorably down. But then, Mark, but inflation's up. No. CPI is up. That isn't inflation. That is devaluation of the currency. Oil prices went up because we devalued the currency in which we price oil. Priced oil and gold, it's not up. If you priced anything in gold, it's not up. But when price it in a devalued currency where the liquidity got increased temporarily. So the big question to your point, which is the really brilliant question, are they going to restart QE? Are they going to put more liquidity? The answer is yes, for sure. You asked the question, do they have to break something first? What they have to do is they have to reload the gun, right? In order to shoot the gun, you got to put bullets in it. So in order to be able to lower interest rates when the economic contraction happens, you have to raise interest rates. Now, they should have raised interest rates in 2013, but they didn't because they were still bailing out the banks. Because remember, Fed funds, the only people that borrow at Fed funds are banks, right? You and I don't get to borrow at Fed funds. We pay prime rate or worse. I saw a stat the other day, Daryl. This is unbelievable. The average loan interest rate for cars is well into the double digits. And it goes as high as 29%, depending on your FICO score. So, everyone looks at the 0% interest or the 3% interest. That's for a very small number of people. The average consumer that is a subprime risk is paying mid double digits and sometimes into the 20s for a car loan.
My sisters, they had the same thing. I was like, hey, I would have took on that loan for y'all, but they're paying 20%.
Unbelievable. No, it's unbelievable. And how do you get out from under a 20%? That is usurious, right? And nobody really talks about it because the media focuses on the wealthy. The media focuses on, what Visa and MasterCard want you to believe, that, credit is good. And here's the interesting thing. I'm a little older than you, but when I was growing up, my parents and grandparents, depression babies, debt was evil. I mean, debt was a no-no, right? You wanted to have your house paid off, right? You wanted to have a mortgage burning party. You didn't want to have a credit card. And I ask people all the time, I say, what is this? And I'm like, well, it's a credit card. I'm like, no, it's not. It's a debt card. How much would you use it if it was called a debt card? And you think about it, if you have a big credit line, you're a big person, you're a big man, big woman. If you have a lot of debt, you go to debtor's prison. It's the same thing. Credit and debt are the same thing. And yet somehow we glamorize debt. In fact, there's one of my favorite commercials. There's this guy in a backyard barbecue with all his friends, and he's cooking, and he's got the two big cars and the pool and the big house. And his friend says, how do you afford all this? He's like, I'm in debt up to my eyeballs. Like, yeah, exactly right. And that ends badly. And 40%, it's a crazy number, 40% of the S&P 1500, right? The top 1,500 companies in the country. Not only can they not pay their debt back, they can't even service their debt. They can't even pay the interest on their debt with their current EBITDA. It's insane. So how do they survive? Well, the banks keep extending and pretending. They keep extending the loan. And the problem with that is we live in a world that's very tenuous because, again, in the old days, the banker lived in my neighborhood, right? My dad knew the banker. Right? He knew us. He knew where we lived. He knew what our house was. And he made a loan in a world of hedged finance. He lent us money expecting that my mom and dad would pay back both principal and interest. Okay. Then 20 years later, we moved to a world of speculative finance where they'd make you a loan and they knew you couldn't pay back the principal. There was no way, right? But you could pay the interest. So you got an interest-only loan or a bullet loan or variable rate, but they knew you could pay the interest. Well, now we're in a world of Ponzi finance where they know they can't even pay the interest. So they don't even ask you to pay the interest. They just refinance it. Companies issue bonds with zero coupon. I'm like, well, what do you mean zero coupon? If I'm a bondholder, I want to get paid a coupon. That's equity if it has zero coupon. So we live in this Ponzi finance world where as long as liquidity keeps being created, things go up. But as we've seen, as soon as liquidity starts coming out of the system, bad things happen.
Yeah, I agree. And a lot of people don't understand, like, they see, the accumulation of debt, but a lot of the wealthy people do that under LLC, that they can get off from under.
Oh my gosh. Look, there's a huge difference between in an inflationary world, the one that we live in, right? Where the Fed can create money out of thin air. If you have wealth and you buy appreciating assets, okay, real estate, stocks, and you buy them with debt, you crush it, right? The best strategy in the last 20 years in this period of rampant excess speculation and money printing has been to own things like real estate and stocks on margin. But unfortunately, that's a very small number of people at the tippy top. The average person doesn't own their house, they rent, right? They don't own their car, they rent it. And they're paying the 20% interest, and you can't get out from under that. And the asset depreciates, right? The car doesn't, contrary to Elon saying that your car is going to appreciate, cars will never appreciate. They will never appreciate. Cars wear out. Houses actually shouldn't appreciate. They should wear, they wear out too. But the land, which actually is scarce, particularly in places like, where you live, where there's water everywhere, land is scarce. So fine. Not where I was last week. I was out in Utah. There's a lot of land in Utah. I mean, like a lot of land. And it's beautiful and spectacular and hot. But there's a lot of land. So land there shouldn't be as crazy as it is. But you go to Park City, and land prices are crazy because everybody wants to be right there in Park City near the ski resort. But you go anywhere outside Utah, you can buy land for nothing because there's lots of it. But probably don't want to live that far away from civilization.
Yeah. Yeah, I agree. And that was powerful that you said, like, people can't get off from under that debt. Versus, like, if you were in a LLC, if you had to go bankrupt, you can get off from under that debt, and it doesn't
No,
affect you.
the difference between a remote bankruptcy and a personal bankruptcy is monstrous, absolutely monstrous, right? You have a business entity set up with fancy lawyers, you pay pay good money for it, and that has to whatever, seize the assets of that. No personal recourse. Most of us, right, the average person has to file bankruptcy. And look, again, not to rat out my family. I've had 2 members of my family have to declare bankruptcy at different times. And it's not like the old days where you are a pariah the rest of your life. I mean, you get out from under it, but both of it was from predatory lending kind of situations where, one was credit cards and the other was real estate. But it's an interesting dynamic in that the haves and the have-nots, I argue, exist because of the Fed. Right? The Fed, I believe, was created to create this gap, this income and wealth inequality, because what it does is it siphons money to the top through inflation, and it destroys the value of people's livelihood at the bottom, and it makes classes, right, serfs and overlords. And the thing that I don't get, right, politically, is why do the masses vote for those people? You look at Venezuela, right? Venezuelan people are suffering, yet Maduro stays in power. How? Or in Argentina, how does Cristina Kirchner get elected? I mean, she should be in jail. Now, she probably will go to jail finally, but I mean, she should be in jail. How does she get elected? Handouts, right? And so what's really popular right now? Handouts. Oh, I'll forgive your student loan. Oh, I'll write you a check for gas. Oh, I'll give you a free handout, right after the COVID lockdowns. That's a very dangerous kind of banana republic, third world dictator world. That's not a world I want to live in. I don't understand why the average person doesn't say, I don't want to live in that world either. But when you're desperate, and look, touch wood, I've been very lucky. I was born to hardworking parents. They put me through college. I've worked hard my whole life. And so I am lucky, and I don't mean this in a braggadocious way. I am grateful. I don't know desperation. Doesn't mean I won't. I mean, something bad could happen tomorrow, right? But I do know plenty of people, and desperation is different. When you are desperate, when you are really buried asunder, whether it's with debt or whether it's, with just personal situations, look, we're all one phone call from our knees, whether it's health, whether it's family member. I mean, so I'm not again, not being braggadocious. I'm just saying I'm lucky, and I am grateful to not have to think about, well, why would someone vote for the people that are stealing and putting it all at the top? Well, because those people promise them something, and something is better than nothing. And that's a very, I don't know. I don't like that dynamic.
Yeah, you get the crumbs. You get the crumbs of the pie crust, and
right. Yeah, so let them eat cake thing, right?
Yeah, for sure. And I was reading. I've mentioned this a few times. Reading some of Lynn Alden's work, and she talked about, like, when they started after the pandemic, they started, like, the big corporations were getting bailed out first.
Yes.
And, bigger businesses, they were able to get bailed out first and were able to receive a lot of income, and they were able to buy, goods and services, assets cheap, before it even trickled down to the average person. And by the time it got down to the average person, those assets were more expensive. And so
100%. Look, I believe the whole nonsense of lockdowns, right? I mean, we weaponized the flu, I mean, literally.
Yep.
Now we know that it's a flu virus and it mutates, and so we weaponized it. Not we, they weaponized the flu. they created this hysteria, exactly to your point, so that the rich could get richer. Here's a crazy stat. In that period, $3.5 trillion went from the average person to the top, the owners of those big corporations who benefited because we all had to use Amazon. We all had, we could, and the small business owners absolutely decimated. And it's still happening, right? The whole nonsense of, anything related to, look, as a human species, we've been dealing with viruses for thousands of years. We have. And we should deal with them the same way we always have, which is, if you're sick, stay home, right? If you're not sick, live your life. And it's interesting in that in society, we all theoretically believe in innocent until proven guilty, although we all know that's not 100% true. But it's supposed to be healthy until proven sick, right? Is like, I use the example, in Hong Kong, back in bird flu and SARS, they installed these temperature sensors. When you walk off the airplane, it scanned you to see if you had a fever. And it was like, oh, that's intrusive. I'm like, that's fine with me. If I have a fever, I want to know. And I'm happy to isolate. Quarantine is isolation of sick people, not isolation of healthy people. The word quarantine means sick people go away for 40 days. That's the meaning of the word. Not healthy people sit in their apartment by themselves. So this whole process of the lockdowns, of the slowdown, of the Great Reset, actually made the problem worse, not better. And now what we're finding is the average person is further behind, and the average small business owner is really further behind. And it's a very crazy situation from the standpoint of what we all need, right? Just as a society is for a community to support itself, to support each other. And if any society gets too top heavy, history is not kind. Roman Empire, Ottoman Empire, British Empire. Once you become so enamored of yourself at the tippy top, and you think that you can do whatever you want and spend whatever you want and give it all to the cronies, bad things happen. And I think, unfortunately, the American empire is experiencing a little bit of that right now. And you look what's happening in China and Russia, and everyone's like, oh, they're the bad guys. I'm like, well, they're actually collaborating and building this network, all from China all the way up to Russia, including all of Southeast Asia, all of India, Pakistan. All those countries are all Africa, all collaborating. And if you look at back to liquidity, who makes the rules? He who has the gold makes the rules, or they who have the gold makes the rules. Well, who bought up all the assets in Africa over the last 20 years? China. Who bought up the Greek assets in the Greek? China. So what do? They come in, they provide funding. In the event that the people can't pay, what do? They take the assets. And now they own strategic assets all along this, new Silk Road. And, they're doing direct transactions with Russia for oil, denominated not in dollars, not like the good old days where everything was denominated in dollars, but they're doing it in renminbi and ruble. And so everybody's like, well, we sanctioned Russia. The ruble's collapsed. No, the ruble's actually up versus the dollar. So it's just a really interesting dynamic. And look, people always say, Mark, if you hate America so much, why don't you leave? I don't hate America. I hate the direction we're headed, and I hate our leadership. I mean, of all, and this is not about one person or one side. It's our leadership is broken, right? Our model's broken. Lifetime, politicians is broken. There should be term limits. And for me, it doesn't matter. I always say there's no left and right. There's in and out. When you're in, you do or say whatever it takes to stay in. And when you're out, you do or say whatever it takes to get in. And that's why people flip-flop, right? We've got lifelong Democrats becoming Republicans, or lifelong Republicans becoming Democrats. And it doesn't matter, right? It's all about in. I want to be in. And once I'm in and I've been bought and paid for, then what are you going to do? You're going to do favors. Like I'm still incensed. I mean, literally incensed by this thing in New York, right? This woman governor, and this wasn't even a lot of money. I mean, she took not that $300,000 isn't a lot of money. It is, but it's not a lot of money relative to the big picture. But she took a $300,000 gift from this family and using emergency authorization, meaning no bid, no contract negotiation, awarded them a $65 million contract for COVID tests. That's corruption. That's graft. That is wrong. Morally, spiritual, that's just wrong. And ethically. And yet she did it with no worry of any prosecution. No, look, I had the authorization. It was emergency powers because we were in an emergency. Well, we're in a made-up emergency, and you shouldn't be able to do that individually, right? There should be checks and balances. But that's the world in which we live. So how do we deal with it? So we protect ourselves.
Really quick to that point. I was I was listening to my favorite artist, Lupe Fiasco. He did a recent project, and he was talking about and he said he had this very profound line. He said, how should they have such views of the ocean instead of hanging by the neck from the gallows with their neck neatly broken? And I was thinking, like, historically, like, people would like revolt and like they would hang politicians. Like,
yeah, exactly.
And now it's like obviously we don't want people like going out and doing that, but like that was like how it happened historically. If they wanted to remove,
look, I'm with you. I don't want to get back to physical violence, but rising up is real. And how do you rise up? Right, you rise up with your voice. It still galls me. 51% of people didn't vote last election. I don't like either candidate. Doesn't matter. Vote, right? Have a voice. Be part of the democracy. In fact, for me, right, I'd make it so you couldn't even have a driver's license if you didn't vote. Like, that should be like the rule, right? You vote. Now, they should make it easy, right? You should be able to do it from a cell phone on a blockchain. There'd be no fraud, no vote early and often, no lost ballots, because every ballot would be known the moment it was cast. We'd know we'd know the outcome of the election the moment the polls closed, because blockchain is permanent, immutable, and public. There'd be no cheating, no fraud. Well, geez, that's un-American. No, that's exactly American. No cheating, no fraud. But look, I think what's really interesting, and it's why shows like yours are so critical. Investors need to protect themselves. And how do you do that? Sound investment policy, right? Long-term focus on diversification, focus on building wealth, as opposed to speculating and gambling. Focus on, making sure that if you do have a small number of eggs in the basket, if you don't believe in broad diversification, that you're really watching the basket, and that you don't suffer from the arrogance that we all have, that you have to be right. Look, if you're one of those people that has to be right all the time, investing can be a very painful place, because the legends, right? My mentor just passed away last week, Julian Robertson, amazing man, 90, lived to be 90. Look, if you make it to 90, it's a hell of a ride. And he was just an amazing man. And he was an amazing investor. And I learned so much from him about how to invest. And when you think about this idea of diversification and compounding, he was really adamant about, look, you can't think that you're right and the market's wrong, because even he, legend that he was only right 58% of the time. Right? Soros, Steinhardt, Robertson, Paul Tudor Jones, Stan Druckenmiller, they're right around 58% of the time. The average investor is right 40% of the time. Now, that's a problem. If you're right less than 50, bad things can happen if you don't readjust. And so when something goes against you, his big line was live to fight another day. Just get out of the way, right? You're not right. The market's right. And when he would win, and this is something that most people aren't good at this, and most people probably shouldn't do this, but it is amazing, is he had an uncanny ability to double up. He would press his winners. Whereas conventional wisdom that I actually believe in is we should rebalance, right? We should take money from our winners and we should feed our losers the things that we think are below fair value. But there's a difference between buying Shopify, right, at 100 times revenues that was not value in any way, right? And then having it go down 50% and buying more because you think you're rebalancing. No, that's just pressing a bad bet. Whereas if Shopify got down to 2 times revenues, maybe you would want to buy some. But at 10 times revenues, I still think it's expensive. Yet there are plenty of companies now that sell well below their fair value, or Bitcoin, right? Bitcoin's fair value, $31,000, $32,000. We're selling below that. So I would be acquiring that, right? Bitcoin's actually only been cheaper 7% of its history relative to its history. Whereas NASDAQ today has only been more expensive 7% of the time. So we're in the 93rd percentile expensive for stocks, tech stocks, and we're in the 93rd percentile cheap for Bitcoin. So I'm not saying take all your money and put it in Bitcoin. I'm saying rebalance toward the assets that are under their fair value and away from the assets that are above fair value.
Yeah, and that's what I've been telling my audience too. Like I've been dollar cost averaging in the Bitcoin, and I'm not trying to. I think it it may be lower. I mean, some people saying the bottom, whatnot, but I'm not trying to time tops and bottoms. I just think right now is a good time where me personally, I can dollar cost average into it.
100%. We are in crypto spring, right? So crypto winter ended, I believe in mid-June, and crypto spring will be with us for 6-9 months. And we'll have volatility, like spring, right? Spring, right? One day it's hot, one day it's cold, one day it's windy, one day it's not. It's just
especially in Washington.
Especially in Washington. And but then summer will come, and summer will bring, right before the next halving, will bring another bull market, and hopefully not another laser eyes fiasco, but it'll definitely bring another bull run and more adoption and more use, and I think the same thing's true in equity markets. I just think we're still in winter because liquidity is contracting, the Fed is still hostile, and other central banks around the world are still hostile because they're trying to defend their own currency. So global liquidity is contracting at the fastest rate it has ever contracted. And so that's just not, they say don't fight the Fed. Well, don't fight the Fed down either. So now's the time, I think, to have lots of liquidity, right? Cash and cash substitutes, to buy what's on sale, not to speculate on what's super expensive, not to press your winners, and to be patient, right? And patience is really important. The thing about investing, my other favorite line about investing came from Roy Neuberger, right? Talk about a great long life, right? The guy went in the office every day to his 94. He managed his own money to his 101 and finally passed at 107. Now that is a good life. And what's interesting, he said there's 3 rules to managing money. Rule number 1, don't lose money. Rule number 2, don't lose money. Rule number 3, don't forget the first 2 rules. Now that's impossible, right? You can't avoid loss all the time. But if you aspire to lose less by diversification and to trim your losers fast and don't press losing bets, you can manage your losses. And then the gains take care of themselves. Because once you have a portfolio that's full of assets that are under their value, then you can prosper. And if you have a decent amount of cash that you can use to buy the things that go on sale, right? Investing, Daryl, only business. When things go on sale, people run out of the store. Every other business in the world, you put stuff on sale, put TJ Maxx, put wedding dresses on sale, boom, people are like clawing all over each other. Look at Black Friday, they're beating each other up to buy some toy. You put stuff on sale, people are running into the store. In the investment world, things go on sale, people run out of the store. And the cheaper the price, the further they run. Like, no, just stay in the store. But you got to understand value, because price is not value. Price is a liar. Someone tweeted out Jeff Bezos's 2001 letter, right? Stock was down 94%, went from $100 to $6. And his opening word was ouch, exclamation point, right? Ouch. Been a tough year, capital markets, really tough for Amazon shareholders. But he said, but in every metric of fundamentals, Amazon's a better company. And so, yes, the price went down 94% because people had lost faith. They're like, this e-commerce thing's not going to catch on. But in every measure of business, they were doing well. And so those are the things that you want to buy. And if you look at Bitcoin, for example, every metric, right? Number of wallets with a certain amount of money, number of transactions, hash power, hash rate, all of that stuff has been on a steady, inexorable rise. And there's volatility to it, but it's going up. It's getting better. And there are companies that are continuing to generate good cash flows, right? Real cash flows and are growing. And there are others that will never generate. I mean, there's a bunch of software companies, cloud companies, and I debate with my guys all the time on this. They're like, oh, we got to buy these things. They're down so much. I'm like, they're down because they should be down, right? This one company will never make money. I mean, it's a big software company. I won't name it, but it's never going to make money. Not ever. And it's the old line that Jeff said at a board meeting, oh yeah, we lose money on every transaction, but we make it up on volume. Ha, ha, ha. No, that doesn't work. You eventually have to figure out how to make money. And, this software company gives their software away basically for free. And then they think they're going to monetize someday. And that worked for Facebook, right? They could give the product away, not make any money, stock price collapsed. And then they're like, oh, advertisers, you want access to our 3 billion users? You got to pay, and you got to pay a lot. And their revenues went to the moon. And so that model worked in a monopoly-like business. It doesn't work when there's thousands of software companies competing against each other. If you're the monopoly like Microsoft, fine, it can work. And Microsoft's had a really good run in the past 3 or 4 years. But people forget, from 2000 to 2020, the net return on Microsoft was 0. And you had to endure an 80% drop and then a 5 times gain to get back to 0 over a 20-year period. That's a long time. So if you pay too much for an asset, it may be a very, very long time before you get even.
Yeah, I was thinking about like when you mentioned Jeff Bezos, like his letter, just how fast technology progresses. Like there's a lot of people working on Lightning and all types of things in the background. Yep. I mean, and you look at from that 2000 to even 2006 like time. I mean, you had Facebook emerge, MySpace, yep, YouTube. I mean, it was a big boom in tech innovation and whatnot.
Oh, unbelievable! I mean, YouTube is a great example, right? Yeah, I have a unique family. I have 2 older kids and then a caboose who's 20 years younger than his middle brother, and he's 11. He learns everything, and I do mean everything, from YouTube. Everything, right? I mean, last night he, for whatever reason, he was watching a YouTube video on Fukushima and what happened with nuclear energy, because he's all about nuclear energy. Like, I don't understand why everybody hates nuclear energy. Like, been 1 or 2 accidents relative to the loss of life in coal. You're 11. But he's learned stuff on YouTube, and then he does his math, right? He's learning his math on YouTube, and he's learning, whatever, how to play Valorant, right? That's where he spends most of his time on YouTube. He's watching others, play the game, and he's learning. And all that content is created for free. I mean, ABC, NBC, CBS used to pay millions to get the actors and the sets and to make content. And then they'd have to monetize the content. YouTube gets their content made for free. I mean, the mind just blows. And that's an amazing business. And that tech didn't exist 20 years ago. And something will come along and replace it. But to your point, I think it'll be a decentralized solution because, why should Facebook get paid every time, we watch a video? Why shouldn't you or I get paid for creating content?
Mm-hmm. Yeah, for sure. Well, Mark, I appreciate you for coming on. So any final thoughts to just the audience? I mean, we talked about a lot of things, but liquidity, I think that was very powerful. Being able to have some cash and buy real assets. That's kind of like what I'm
Look, I think I'll leave you with the 3 C's: conviction, courage, and cash is what separates the greats from the rest. Conviction is what you get from doing the work. Only way. If you don't do the work, you can't have conviction about anything, right? If you don't spend the time to understand and to really dig in, then you can't really become like if you hear somebody say, buy this, and you buy it, well, but you didn't do any work on it. And so as soon as it goes against you, you don't have any conviction, right? Because you did. So conviction is really, really important. And conviction only comes from hard work and doing the work yourself. Second is courage. Courage is tough. I love, your byline, right? Think, act. What was it? Think, act, prosper. Think, think, act, prosper. Act. So many people think. So many people talk. So many people, kibitz. Very few have the courage to act. And courage is tough, right? The world's a scary place. Investing, scary activity. Courage is really, really important. And how do you get courage? Just doing it over and over, getting better. It's like practice. It's like, lifting weights, right? First time you lift, it's really hard. It takes courage to get out there and do it again. And after a while, it gets easier because it's like anything, practice. So courage, really, really important. But then cash. Cash is an underappreciated asset. Seth Klarman, very famous value investor, famously had 40% cash in his fund and charged 2 and 20 fees. And one investor came to him one time and said, I shouldn't have to pay 2 and 20. You have 40% cash. I shouldn't have to pay you for cash. He says, oh my God, you think you're paying me in spite of the cash? No. You pay me the high fees because of the cash. I make 20% compound returns because I have cash to buy the stuff that goes way below fair value at the time when everyone else is afraid. And so I'll just give you your money back and you can leave. No, I don't want to leave. Like, no, you're out, right? You don't understand how we work. You're gone. I just love that. And there's one other thing that I love from Seth is he had a young analyst. And one of the things he would do is he'd get all the analysts together on his Monday meetings and he'd say, all right, what do we know? And this one young guy says, well, I think. He says, I did not ask you what you think. I said, what do we know? What do we know that are facts? What do we know that to be? I don't want you to think. I don't want you to tell me what you think is going on. I want you to tell me facts. Then we'll analyze the facts and we'll make a decision. And I think that's so important in investing. Julian used to say, don't fudge the numbers, right? Don't tell me what you think it's going to do. Tell me what they're actually doing. Telling what the numbers say. Don't fudge the numbers. And so if you put all that together, right? Conviction from doing the work, understanding, the model that you prosper, the model that you follow, the courage to act, because actions beat words. A lot of people talk big, very few people act big, and then cash. So the 3 C's, I'll leave you with that. Thanks for having me on the show, and appreciate everything you do for the community.
Appreciate you. Thank you.